Good morning, everyone, and thank you for joining us today. My name's Kay, and I'm Head of Healthcare at Duncan and Topless. We're very pleased to have Will Ellis with us this morning, and Will is co-founder and director of BW Healthcare Surveyors. And he's provided help and advice to many GP practices, including a lot of our clients during his 14 years in this highly niche primary care sector. BWH surveyors provide many property-related services, including property health checks, notional rent reviews, lease rent reviews and renewals, market valuations, and sale and lease back, to name but a few. The feedback from our clients who have used them has been excellent, and so we thought it would be great to have Will come along today and talk about some very topical issues impacting GP practices in respect of their properties. If anyone does have any questions, please do type them up in the question and answer screen, and we will pick them up as we go through at appropriate points. If you do think of anything afterwards, then please do feel free to contact Will or myself. We will provide our email addresses for you. So a very warm welcome, and I'll pass you over to Will.
Hi there, thank you for that, Kay. I was just sorting my microphone out. Yes, thank you ever so much for that. Yeah, we're just going to go through a bit of a presentation. So I will share my screen in a moment or two, if that is okay. So just bear with me one moment. Right, hopefully you can all see that okay. So yes, welcome to Succession Retirement Planning, what to do with your premises. We're going to be going through, so we're going to be talking about what to do with your premises, what the kind of options are when it comes to retirement and succession planning. We'll talk about a couple of the options in a bit more detail. So sale and leaseback being one of those options. So we'll go through the pros and the cons of sale and leaseback. We'll also talk about putting a lease in place as an alternative to sale and leaseback, and also transferring the NHS contracts to another entity as well, which may help reduce the liability when it comes to putting a lease in place. And then we'll talk about something slightly different in terms of how to maximise the value of your premises in anticipation of going through a sale and leaseback or selling the premises. And then we can have an open Q&A as well. And I know Kay wants to say a couple of bits from an accountancy perspective as well. Okay, so in terms of the options that you have open to you when it comes to your premises upon retirement, and the first option is in terms of finding new partners, which everybody is aware of, everybody's trying to do. I think at the moment everyone seems to be short of GP partners. Certainly is the first port of call, I think, when partners retire, is to try and find a replacement. It can be very difficult, certainly with GP partners at the moment. I think a lot of GPs are unwilling to buy into partnerships because of the current market, or unable to because of the current mortgage costs and interest rates, etc. There are alternative partners that you can have now if you're not aware, so they don't have to be GPs anymore, so they can be nurses, practice managers, pharmacists, and actually there doesn't even have to be a GP partnership on the contract anymore. So there used to be a requirement that a GP had to be on the contract, but we've got examples of some of our clients where there's one in Wolverhampton, I think, where a couple of them, the contract's actually held by a couple of nurses. So there are alternatives there in terms of finding new partners, and there are also innovative ways of getting partners to buy in to your practice as well. So if one of the stumbling blocks is partners can't afford the what is sometimes hundreds of thousands of pounds for a small share of the premises, can't afford to do that, you can look at gradual buy-ins. So some practices go where they, instead of, let's say you've got 5 partners, a buy-in is a few £100,000 to buy a 25% share of the premises, rather than that incoming partner buying the full 25% share. They could perhaps buy 5% every year for the next 5 years until they reach that required amount. So you can have innovative ways of buy-ins to help that process as well. But failing that option, finding new GP partners, which I think is quite often the first choice for most practices, another option is sale and leaseback, which we are going to go through in a bit more detail. But sale and leaseback is effectively where you sell the surgery to an investor. A third-party investor would come in, purchase the premises. You as GPs, you as the partnership would still hold the contract, still provide medical services. You'd become the tenants and you'd sign a long-term lease to the landlord. You'd pay rent, therefore the rent you receive from the NHS is paid to the landlord. So that in a nutshell is sale and leaseback. An alternative to that, as I mentioned earlier, is putting a lease in place. So you could have a lease in place when you retire. So upon retirement, you want to keep the asset rather than selling it. You would then become the retired partner would then become the landlord with the other owners of the premises, and then lease it to any non-owning partners effectively. So just have a lease in place, and then as partners retire, they become landlords and take themselves off the lease as tenants. So it gives you a bit of flexibility. It's a good option that for incoming partners, because when incoming partners come in, when you're trying to find new partners, they don't necessarily have to buy in to the partnership, because they can just be the tenant side of things. So they can just be signatories on the lease, and it gives you a bit more flexibility that side of things as well. Another option is merging with another local practice, which can help solve succession and retirement issues. So if you have a local practice with a younger set of GPs or younger set of partners, then they can come in and perhaps take over your practice, merge with your practice. So when the older GPs retire, you've got the younger GPs taking over. So merging with a practice is certainly an option. And then you've got, like I mentioned earlier, transferring the contracts to another entity, which can help alleviate the kind of liabilities of being the signatory on the lease. So what sometimes happens is perhaps you want to sell the surgery, but you don't want to sign up to a long-term lease. So you can get a third party in to come in and take over the lease and be signatories on the lease as well. But we'll talk about that in a little bit more detail. And the last option is closing the surgery and selling as alternative use. Not really anything anybody wants to think about doing. This is actually one of the main reasons why we originally put this presentation together, because we spoke to too many, unfortunately, surgeries that were having to close because of retirement and other matters. And some of them weren't even aware of the options that they have. So we kind of put this presentation together to try and explain what the options were, to hopefully avoid any practices having to close the surgery and sell as alternative use, because that's obviously not what anybody wants to see happening. So hopefully this presentation will give you a couple of options to avoid that eventuality. Okay, so sale and leaseback, talked about that in a bit more detail. Some of the pros of sale and leaseback, certainly some of the reasons why practices go through a sale and leaseback. So the first thing to make you aware of is the lease rent will get fully reimbursed by the NHS. So any rent you pay to the landlord is going to get fully reimbursed by the NHS. Effectively, it's your notional rent payment. So if you're in an owner-occupied premises at the moment, you receive notional rent payments, that effectively will become your lease rent, and whatever that figure is, you'll pay that in full. In full to the landlord. So there shouldn't be ever a situation where you're paying more to the landlord than what you're receiving from the NHS. That is as long as you get the correct representation to assist you through that lease process. Make sure you've got the necessary clauses in the lease to protect you. You may have heard of horror stories where practices are paying 20, 30, 40% more to their landlords than what they're receiving from the NHS. But the main reason for that is because they've just gone and pulled a commercial lease off the internet, not checked it, just got everything signed, and it just causes difficulties further down the line. So very important that you get correct representation when you start the process. Sale and leaseback can also reduce the risk and responsibility of property ownership. So under certain circumstances, the landlord would be responsible for the external repair and maintenance of the premises. You as tenants would still be responsible for the internal repair, but the external would fall upon the landlord. Now, what sometimes happens with primary care leases with sale and leaseback is the landlords don't actually want that responsibility either. So you may find when you go through the process that the landlord bats that responsibility back to you as tenants. But if that is the case, then you can actually retain a proportion of the rent that you pay the landlord. So if you're receiving £50,000 in rent, in notional rent or in lease rent from the NHS, you would normally pay that in full, as I mentioned, to the landlord, the full £50,000. But if you're responsible for the external repair, then you can hold back somewhere between 5 and 7.5% of that rent. And the idea is you put that rent into a sinking fund and use that money for any repairs and maintenance that are needed on the premises. So either A, the landlord's going to be responsible for the external repair, or B, you'll be responsible, but you should have that money tucked away safe for a rainy day when it's required. Number 3, so sale and leaseback, it's going to remove the burden of ongoing capital investment. So because it's not your premises, because it's the landlord's premises, it's also their responsibility for any upgrades, improvements and extensions of the premises. It can also help attract new GP partners. So the idea here is is seen as more interesting from a GP partner point of view when you're in a leasehold premises, because they don't have that obviously amount that they have to pay, the funds that they have to find to buy into the partnership, and they just have to become signatories on the lease. So it's just seen as a little bit more attractive. From our experience, practices in leasehold premises do find it a little bit easier than practices in owner-occupied ones to find new partners. It's certainly not a magic wand, so there's certainly still difficulties. There's certainly still issues with leasehold premises and liabilities for the partners to think about, but it just makes it that little bit easier, that's all. Number 5, so having a lease in place will generally create a higher premium value of the property than as owner occupied. So when you put a lease in place, when you go through a sale and lease back, if you have it valued, your premises valued under a sale and lease back, you may be pleasantly surprised that it's valued a little bit higher than perhaps you've had done previously for partnership changes. So the main reason for that is when you have a partnership change, when you have a valuation done for partnership change, it is an owner-occupied premises. There's no security of that rent continuing. There's no security of the premises and the practice still providing medical services and still being in existence effectively. When you've got a lease in place, which you will have when you go through a sale and lease back, you'll potentially have a 10 or a 15-year lease in place. That investor's coming in and they're purchasing the premises, they're purchasing the bricks and mortar, if you like, but they're also purchasing that lease and that guaranteed rental income for the duration of the lease. So effectively, the longer the lease is, the higher the value of the premises is. So it's a major factor when determining value of premises. One is the rental income, and 2 is the length of the lease as well. So it will have a major impact on the value. It can also assist improvement works, extensions, or even new developments. So this was probably a big reason why practices went through sale and lease back, because they were perhaps in need of upgrades and improvements, or even extensions, or even perhaps relocating to a new development. But they were struggling to fund those themselves. The NHS, there was no grant money or funds available from the NHS. So getting an external investor in to purchase the existing site and assist you with improvement works, extensions, or even sourcing new developments and a relocation as well is potentially a great solution to that problem. And that'll ultimately be written into the agreement. So when you'd go through a sale and leaseback, you'd sell your existing site on the proviso that the investor has to spend X amount of money extending, or has to assist you with any potential redevelopment as well. And then the last thing, so in most cases, the tenant will have protected rights for a new lease upon expiry of the existing lease. So under the Landlord and Tenants Act, when the lease expires, you as tenants will have an automatic right to renew the lease for identical terms. So if you sign a 15-year lease, once that 15-year lease expires, you can renew for another 15 years. It ultimately makes it very difficult for the landlord at the end of the lease term just to kick you out and get another tenant in. It gives you a bit of protection there. Okay, so they're the kind of main upsides of sale and leaseback. Some of the downsides, or certainly some of the things that you're going to need to consider when you go through the process. So leases can restrict what tenants do to the surgery. So if you were to make any changes or wanted to make any improvement works and changes, etc., to the surgery, you're going to have to ask the landlord's permission to do so. As I mentioned earlier, it's a landlord's premises, so you can't make any changes to it without their say-so. There may also be specific obligations on the practice under the lease. So the lease may say things like you have to redecorate the surgery every 3 to 5 years. There'll certainly be a clause in the lease that says you have to keep the surgery in its current state of repair. So whatever the state of repair is on day 1 of the lease has to be the state of repair at the end of the lease. Otherwise, there can be financial penalties upon expiry. There will also be liabilities under the lease, including rental payments. So if you're signing a 15-year lease, you are liable for those rental payments for 15 years. And although the NHS have agreed to reimburse you for that rent, that is only on the proviso that you continue to provide medical services and continue to hold the contract. Obviously, if that was for whatever reason to change, so if that contract was taken off you, or you couldn't continue to provide medical services, you would still be liable for the lease rent. So it's just important you're not signing up to a long-term lease if you think there's any chance that the surgery is not going to continue to be there for that duration of time. So it's a bit of a weighing up the pros and cons when it comes to lease length, and it's always a contentious issue, to be honest with you, between partners, because on the one hand, the longer term lease you sign, the higher the value of the premises is going to be, so you're going to get more value for the return of investment for your asset effectively. But on the downside, the longer term lease you sign up to, the bigger the liability is if the practice were ever to close. So it's just something worth considering. A way around it is by putting break clauses in there. So you could sign a 15-year lease with 3-year break clauses, which effectively allows you to break the lease without penalty for that period of time. And maybe every 3 years, there'll be a 30-day period every 3 years where you can put notice in to exit the lease without penalty. The problem with that is that will have a detrimental effect on the value of the premises as well. So like I said, it's just weighing up the pros and cons when it comes to lease terms and lease length. Something else to consider is your early redemption penalties. So the penalty that the mortgage provider will charge for you paying off the mortgage early, effectively their loss of interest for that period of time. So it's worthwhile just speaking to the mortgage provider, picking up the phone and finding out what those early redemption penalties are. They can sometimes be astronomical, especially with Aviva, for example, who are renowned for their sometimes ridiculous early redemption penalties. So just worth a phone call to find out what they are, so you understand that. You must have at least 2 signatories on the lease at all times as well. So if you're a single-handed practice, you're probably more than likely going to have to find another partner to come in and agree to be a signature on the lease. There's going to be very, very few investors that would purchase a premises with just 1 signatory on a lease. It just gives them an extra protection the more signatures there are. So there'll have to be at least 2. If you're a practice with multiple partners, let's say you've got 4 partners willing to sign up to the lease initially, technically the first 2 partners can leave without having to find somebody to replace them on the lease. When you get down to those last 2, that second to last person that leaves is going to have to find somebody to replace them on the lease, otherwise they'll remain liable for the terms of the lease. And there will also be tax implications, a potential tax implication. So it's always worthwhile having specialist accountancy advice, such as from Kay Botley, who I know is probably going to have a quick conversation and explain a couple of things with regards to the tax implications of putting sale and lease back in place and things. So that's worth considering as well. And then in terms of the process, so if you were to go through a sale and lease back, the process would simply be a specialist surveyor would come out and value the premises to determine the value. They'd look at agreeing the heads of terms, so the length of the lease you're wanting to sign up to, and the lease terms, and who's going to be responsible for what, etc. Once that's all been agreed between the partners, then those heads of terms would go to the NHS for approval, which is a vital stage of the process. And then it's a case of going to market and negotiating with any interested parties. So that's kind of sale and lease back. In a nutshell, really. Another option for you would be to put a lease in place, as I've mentioned earlier. So when putting a lease in place, there are a few health warnings for both tenants and landlords. So rather than going through a sale and lease back, as I've explained, you could have a partner retire, they become the landlords and lease it to the remaining partners. Some of the things to consider when putting a lease in place, it's very important that you get a specific GP surgery lease, so a specific lease for primary care, not just a standard commercial lease off the internet. The main reason for that is standard commercial lease, you've got a landlord and a tenant. In primary care, for GP surgeries, you've got landlord and tenant as normal, but then you've got the third entity being the NHS, and that has to be stipulated and clearly stated in the lease under the clauses such as the rent review, because any rent review is going to have to be approved and agreed by the NHS. So that has to be all documented in the lease. So very important that you get a specific NHS lease and not just a standard commercial one. That lease will then, as I mentioned, need to be approved by the district valuer. So the district valuer will undertake a value for money report when you put a lease in place to ensure that it's value for money for the NHS effectively. And then if that passes, then the NHS can approve the lease terms and get everything signed off. Very important that you get an approved lease. It is very difficult to retrospectively get a lease approved, and it can cause an awful lot of issues. So before anything is signed and agreed, I cannot stress enough how important it is to get that lease approved. We have come across far too many leases over the years that haven't been approved. And the issue with it is, you'll probably have no issues with an unapproved lease until it comes to that first rent review, and the landlord instigates a rent review, proposes an increase in rent, and you go to the NHS to try and get that increase reimbursed. And the NHS's response will be, we weren't aware you were in a leasehold premises, we haven't approved this lease, we're not reimbursing you for the rent. And then you're going to face an awful lot of difficulties, because if the landlord doesn't want to alter the lease that you've just signed, then you're never going to get that reimbursement from the NHS. So very, very important to get any lease approved before it is all signed. It is also important when you're putting a lease in place between connected parties, if you like, between the partnerships. When a partner retires, if you're putting a lease in place between the existing partners and the retired partners, there's obviously going to be some sort of relationship there, and sometimes it can be tempting to put beneficial clauses in there, beneficial lease terms in there, perhaps just a 12-month rolling lease, or put break clauses that allows parties to break every 6 to 12 months, which is all well and good. The issue with that is it's going to have a significant detrimental effect on the value of the premises. So if you decide putting that lease in place now because you want to lease it, you're always going to lease it. Circumstances can change. If you then decided to sell the premises in 5 or 10 years time, you're going to have a lot of difficulty with terms that are beneficial to the tenant. So it's just taking a step back from the relationship that you have between the partners, probably seeking professional advice from solicitors and surveyors to ensure that any terms that are in place aren't having a detrimental effect on the value of the premises and other matters as well. It's also important that you clearly state the landlord and tenant's responsibilities. One of the main reasons to have a lease in place is to avoid any potential disputes in the future. So just make sure that is clearly outlined in the lease, and also to check the conditions of any mortgage. So there may be conditions and restrictions in your mortgage that says you have to remain as an owner-occupied premises. So when you put a lease in place, effectively it's defaulting on the mortgage. So you'd have to reapply for a mortgage, which in today's market could mean having to pay an awful lot more in interest rates, etc. And again, there's going to be tax implications, which hopefully Kay can talk you through in a moment or two. Transferring the contract to another entity. So this is a great option for failing and struggling surgeries, or those who might be facing closure due to retirement of their GPs. So rather than having to close the surgery, you can look at transferring the contracts to another entity. So entities such as PCNs or GP federations can hold contracts. You've got local practices via a practice merger, as I mentioned earlier. So local practices can come in, take over the surgery and take over the contract. There are several third-party organisations now as well. These seem to be popping up on almost a weekly basis. So organisations who specialise in coming and taking over contracts. You may have heard of companies like Operose or E. Harley Street or Virgin Care, for example. All of these are third-party organisations who can take over GMS and APMS contracts. You've also got employee-owned trust. So rather than a partnership holding the contract, you can have an employee-owned trust hold it. So whereby each employee, whether it's admin or whatever staff, can hold a percentage share in the trust, and they would hold the contract as a whole. And then the NHS as well. So NHS can also hold contracts. It is probably seen as a last resort. It's worth obviously having a conversation with them if this is a route that you're wanting to go down, but they will probably advise on one of these other options, or at least ask you to explore these other options before they would consider taking over the contract. A transfer of contract as well is also great for things like sale and leaseback. So if you were thinking about sale and leaseback, but you didn't want the liability of putting a lease in place, of signing up and agreeing to a 15-year lease, then you could potentially transfer the contract and then the lease responsibility onto an organisation as well. And equally, if you're a single-handed practice, as advised, it's probably unlikely that investors are going to be interested in purchasing from a single-handed practice, one signatory on the lease. You could look at one of these organisations taking over the contract and being signatories on the lease instead. So just an option to run alongside perhaps sale and leaseback, as well as to assist with any practices thinking of closing. Okay, last couple of slides. So in terms of how to maximise the value of the premises, so in anticipation of perhaps selling the surgery, there are things you can do to help maximise the value of the premises. The main thing to do is make sure the notional rent is checked by an independent surveyor, such as ourselves or any of the other specialist surveyors out there. Just make sure it is somebody specialist in the market who has experience in primary care, and make sure that's just checked. I mean, effectively, your notional rent should be checked. I would recommend getting that checked independently every 3 years, regardless of whether you're thinking of selling or not. But it is never more important than when you're contemplating a sale, is to get that notional rent checked and hopefully get that increased. Also ensuring any lease agreements. So if you lease to any pharmacists or alternative therapists, just making sure those leases are up to date and haven't expired, and making sure any outstanding rent reviews are undertaken as well, so that rent is maximised. And if you're also making the most of any spare space or non-reimbursable areas, so if there's any space in the premises that you aren't currently getting notional rent reimbursement for, if you are using that space, then you could look at seeking approval for reimbursement. Or if you're not using that space, you could look at renting that space out too, like I've explained, a pharmacist or alternative therapist. And then lastly, looking at upgrading, improving, or even extending the surgery. As I mentioned, this is something that a lot of investors are keen on doing because it helps increase their return on investment, will help increase the value of the premises as well. So rather than letting an investor do it, if you have the means of doing it yourself, then it's a great way of increasing the notional rent and increasing the value of the premises as well. Ultimately, all those things are there to increase the rental income, because as I mentioned, the rental income has a significant impact on the value of the premises. And if you can increase that rental income by even just £1,000 a year, that can increase the value of the premises by 10, 15, or even £20,000. It can have a significant knock-on effect to the value of the premises. But that's it really for me. Whatever you decide to do next, it is imperative that you receive the correct advice from specialist surveyors or accountants and solicitors to ensure that you make the right decision. And there's plenty of free advice out there as well. So if you have any questions at all about anything we've talked about, feel free to ask now, or if you want to get in touch with us afterwards, more than happy to have a conversation with you as well. And that is it from me. I'll stop talking now and pass you back over to Kay, if that's okay.
Thank you very much, Will. That's great. Right, I shall just share my screen with you. Screen is live. Fabulous. Right. Okay, super. Right, thank you very much, Will, for that really informative presentation. Will mentioned at the beginning about different considerations for buy-in, including phased buy-ins, and we have actually seen a few of those in recent months, where partners, incoming partners, probably don't have the cash flow to buy into the full share, and so some of the other partners have allowed a phased buy-in to just assist with that. We'll also mention sinking funds, and so I just thought I'd mention there as well. We do encourage practices, whatever the arrangement is, to ensure that they do put money to one side regularly, so that they know they've got the funds there to make sure that the practice property is looked after well, it's decorated, regular maintenance and upkeep, be you a tenant or if you are property owners. And that is to ensure that all incoming and exiting partners contribute fairly to reflect their use of the building. We have seen some horror stories, one where they thought that they had been holding back money from the partners annually, but unfortunately the accountants that they'd been using hadn't dealt with it properly in the accounts. So all that had actually been happening was there'd been a bank transfer from the current account to a savings account, but there was no actual money held back from the partners. So some older partners had exited without actually leaving any cash behind to contribute towards the need in that surgery for quite a lot of work to be done. We've seen it with leases as well, where we've taken on new clients, and unfortunately they've been going through a process where the lease has obviously got the clauses in to make sure that you're looking after the property, and a lot of work was about to be required to get that up to spec, and quite a number of partners had use of the surgery and left and not contributed towards that. So they were then finding that the incoming partners were having to pick up the bill to get the property into the condition it needed to be to comply with the terms of the lease. So just a few pointers there to make sure you're considering. Okay, so I'm just going to touch now on a few frequently asked questions and issues that impact the accounts where the property is a partnership asset. And I'll also touch on a couple of the taxes that will impact partners where there are changes in property ownership. So Will's obviously mentioned various scenarios in respect of how property may be held. If we first just look at a property being held as a partnership asset, so we see various scenarios in respect of buy-in. Some GP practices will have GPs coming in and taking out personal loans to buy into the property, but more and more we are seeing that either practice loans or a mixture of practice and personal loans are being taken out. Some practices will take out practice loans to a certain level such that they then feel that the remainder of the buy-in is a reasonable figure for new GPs to source their own personal loan for the remainder, for example. Another example that we often see is in respect of practice loans. So where a practice owns the property and they have practice loans, obviously they're getting paid off and the equity is building up. Incoming GPs may need to take a higher share of that loan rather than injecting cash or taking out a personal loan. And perhaps other GPs might be happy to move some of their loan across to the incoming GP because they're probably in a position to effectively be able to pay some of their share of the loan off and ultimately save on interest and costs that we're now seeing. So another option there, if there is some flexibility within the partnership and within the partners, and that is something that we have seen on several occasions where the GPs that have been there a bit longer are in a financial position to say, actually, I'm happy to pay some of mine off, and that frees up some of that practice loan for the incoming partner, and we just reallocate that. It's possible. We prepare the calculations in a number of sets of practice accounts to reflect those different allocations of loans, repayments and interest. Sometimes not all of the GP partners will own the property. Some new GPs or partners joining a practice don't wish to buy in. The property can still be held as a partnership asset, but with clear reference in the partnership agreement around how property related income and expenditure is shared and clear reference to responsibilities and liabilities. So as we said earlier, it is really important to seek specialist advice when you're looking at any property changes, be it leased or owned. So just to look at some of the taxes now. So we're just going to start with stamp duty land tax. So where stamp duty land tax is charged on a new lease, the cost of that stamp duty land tax is spread across the life of the lease. And that's a query I've had recently. And that's to ensure that any exiting partners will only take a pro rata share of that cost to the point of leaving. And any incoming partners will then pick up their share, their pro rata share from the date they join until the date they leave. So it's spreading that stamp duty land tax across the life of the lease, so everybody gets the fair share of that cost. In respect of owned properties and partnership changes, where the property is a partnership asset, then providing there is at least one continuing partner and the asset remains a partnership asset for 3 years after the transaction takes place, then there is an exemption that applies and stamp duty land tax wouldn't be payable on the transaction. We've then also got business asset disposal relief, and this used to be known as entrepreneurs relief. So if you are eligible, this means that you'll pay 10% capital gains tax on all gains on qualifying assets rather than 20%. So that's if you're a property owner and you're selling the property. So if you're retiring and selling your share of the practice property, then to qualify for business asset disposal relief, you must have been a partner in the practice for at least 2 years prior to the sale and owned a share of the practice property for at least 2 years prior to the sale. There'll also, of course, be times when you might sell a share to incoming partners, but still retain a share of the property. So, for example, if an additional partner joins and buys in, if we say there were 4 equal sharing partners and now there's going to be 5, you'd be selling 5% of your property share to the incoming partner. And for any sale like that to qualify for business asset disposal relief, you need to again have been a partner in the practice for at least 2 years and owned a share of the property for at least 2 years before the date of sale. But you also need to be reducing your interest in the partnership by at least 5%. So, and that 5% rule is regardless of what proportion of the partnership property you're selling. So in this example, it's quite straightforward because there's 4 partners at 25% each, and it's then going to be 5 partners at 20% share each. That's practice profit share and share of property. So they've sold effectively 5% of the property and reduced their profits share by 5% and the ownership of other elements within the practice. But it's not always that simple. So you might be thinking, oh, I work 10 sessions a week. If I reduce to 9.5 sessions, then that's fine. But if your fellow partners are dropping sessions too, or anybody leaves, for example, then your overall share of the partnership would actually be increasing without you even doing anything, even if you are dropping slightly. So you do really need to consider carefully what disposal of at least 5% will look like. So again, always talk to your accountant. There is also a lifetime limit on business asset disposal relief. So for disposals on or after the 11th of March 2020, that was £1 million. And I've just put a bit of detail on that slide there as to what those limits are. So as Will has already mentioned, you know, I completely agree. Our recommendation is that you do seek advice from a specialist surveyor like BW Healthcare, a specialist accountant like ourselves, and a specialist solicitor as appropriate. It is essential that your advisors have knowledge of the sector. We've seen examples of solicitors trying to charge stamp duty land tax on partnership changes a couple of times over the years. So an investment in someone who knows what they're doing can save quite a lot of money in the long term. They are very complex rules, especially where more than one tax comes into play, because they can impact on each other. So it is vital to get the right advice. So if anyone does have any questions, then please do feel free to email us. I'm just going to check there weren't any questions in the chat screen. Just have a look and see if there's anything in there now. No, there aren't any questions in the chat screen, like I say, so do feel free to email us. I'll just drop my email on it if you want to as well, Will. Just drop our emails in the Q&A screen in a second. But I would just like to thank Will once again for joining us today and for such an informative talk, and to thank you as well for joining us. I'll just type my email in. Of course, you have got the details where you logged in that will come through, and it will all feed through to us as well. So super. Well, still no questions popping up. So thank you again. Enjoy the rest of your day, and we hope to see you all again soon. Thank you very much.
Thanks, Kay. Thanks all. See you later.
Thanks, Will. Bye.